Now we'll be starting with the next topic, that is AS20, earnings per share. Right now, this is a very important accounting standard, and this is a group 2 accounting standard again. This is a Acha, now I wonder why the students are less, because we are doing group 2 standards over here. So the students those have taken admission for group 1, they might have not come in this lecture. Right. But now we are doing AS20, earnings per share. It's a group 2 accounting standard, and it is a pure practical accounting standard where we have to solve the questions. Right? And this is very important from the exam point of view also. And I want everybody to please keep your notebooks and pen, because there are many points that you have to note it down now itself. Right? Don't tell me that you please send a PDF and I will copy, because here practical sums are there. So it would be advisable if you copy it with me. If it is pure theoretical content, for that I've already sent you the PDF, so theory can be copied later on also. But sums, you have to do it with me only. You cannot copy the sums later. Right? So please, everybody, keep your pens and notebooks ready with you. Right? Let us understand what exactly this accounting standard is, and what are we going to learn from this. Is financial management started? FM started? Okay, some people saying yes, some people saying no. Okay, no problem. And even if it is started, I don't think so. You might have reached to the topic called as leverage. Is leverage done? No. Okay, no problem. Fine. Then it is all upon me now. Because if leverages and all are done, then this topic becomes more simpler to explain, because you've already learned about EPS in that FM topics. So here it becomes easy. So no problem. What is the name of the standard? AS20, earnings per share. Earnings per share means what company has earned for every equity share that is outstanding in the company. Means if a company has 1 lakh equity shares issued, right? Total 1 lakh shares issued. So in this chapter, we are going to calculate how much each and every equity share earns out of the profits available of the company. Means in simple terms, I can say, if the net profit for the company is 5 lakh rupees and you have 1 lakh equity shares, 5 lakh divided by 1 lakh, 5 lakh divided by 1 lakh, you get answer as 5 rupees. So 5 rupees is earnings per share. So a company has given you an earnings of 5 rupees for every equity share that you have held in the company. And sir, trust me, EPS is one of the most important financial ratio. It is a very important financial ratio from an investor's perspective, because EPS makes, or I would say EPS helps in decision making for an investor whether to invest in a company or not. Because higher the EPS, higher will be the chances of company's future growth. Because if a company is able to generate a very high EPS, means the company is superbly performing, and you can invest in that company. So sir, there is one chapter in your financial management called as ratio analysis. You might have already seen your module, or you might have seen your JKSC material. There is one topic called as ratio analysis. And in that ratio analysis, you will learn not less than 50 formulas. 50 financial ratios you will learn. Now see, why we learn financial ratios? Sir, we learn financial ratios to understand about the company, to understand the financial feasibility of the company. Right? So out of those 50 formulas, one of the formula will be of EPS, because EPS is also financial ratio. And sir, we don't have accounting standard for any other ratio. We have accounting standard only and only for EPS. But for the rest 49 formulas that you are going to learn, sir, we don't have any standard for it. So you can just imagine from this how important EPS would be. Because for just this simple formula, for just this financial ratio, they have made an entire accounting standard only. So this is a very, very important financial ratio for which an entire accounting standard is made. So what is the objective? It prescribes the computational methodology to calculate EPS. Means it will tell you the method or simple terms, the formula for calculating EPS. And sir, please understand why a standard is made. A standard is made because every enterprise should calculate the EPS in the same manner. There should be a uniformity. Because if there is a uniformity in calculation of EPS, an investor can blindly compare it with other enterprises. Means, for simple instance, I want to invest in pharmaceutical companies. So what are the pharmaceutical companies available to me? Sir, I have one Cipla. Sir, I have Dr. Reddy. Sir, I have Laurus Lab. Right? I have AstraZeneca Pharmaceuticals. I have 4 or 5 pharmaceuticals company. I have Sun Pharma, which is very famous, Sun Pharmaceuticals. Right? So I have 5 companies. But sir, in which company should I invest? For that, I will check the EPS of all these 5 companies. And to compare the EPS of all these 5 companies, can I say the calculation should be uniform? Because if they are followed the uniform means, then only the comparison can be done. That is why we have a standard for this. So every company who is calculating EPS will follow AS20 for sure. We have to follow AS20. So technically, when I say that it is a ratio means what? Numerator upon denominator. What is a ratio? Ratio means what? Numerator upon denominator. So in this accounting standard, we will learn, or this AS prescribes the numerator and the denominator to be used in the calculation of EPS. Right? And I'll tell you one thing, calculating the numerator is very simple. But the biggest problem is calculating the denominator. And for the denominator only, our maximum time will be invested. Numerator will be completed in 10 or 15 minutes. Denominator will take 1 hour. Right? Now let us talk about the applicability. You have to note down this. You have to note down this. Applicable. Let me talk about applicability, then you can note down the objective and applicability together. I'll give you 3 to 4 minutes to note it down. Applicability. It applies only to corporate entities. Means this is applicable only to companies. Because sir, earnings per share, shares are there only with company. Can I say proprietorship, partnership, cooperative societies don't have shares and all? So they will not have EPS. EPS is applicable, AS20 is applicable only to corporate companies, that is corporate entities. And one more point, EPS are of 2 types that I'll be talking about, basic EPS and diluted EPS. Basic EPS is applicable to all type of entities. All type of entities as in small company, small and medium company as well as large company. But when it comes to DEPS is diluted EPS, which we will be talking about tomorrow, because today we will not reach up to diluted EPS. But calculation of diluted EPS is mandatory only and only to non-SMCs. Non-SMCs means only to large companies. Small and medium companies need not calculate diluted EPS. It is not compulsory for them. Right? It is voluntary. If they want, they can do it, but it is not compulsory. But basic EPS is compulsory for every company. And this EPS is calculated every year by the company, year after year. Because a company will compare its EPS of current year with the last year's also to check their performance. And an investor will also check EPS of this year with EPS of last year's. So that the investor will also come to know whether the company is overperforming or underperforming. And as an investor, I would always like to invest in a company with a very high earnings per share. Because if the EPS is high, means the company is having a lot of potential to earn for its shareholders. And I don't know how much technically qualified you are, but higher the EPS, higher is the chances of dividends. Because dividends are always issued from the earnings. Means if I say that my EPS is 20 rupees, earnings per share is 20. So out of that 20, company will give you dividends and balance will be transferred to reserves. That is called as retained earnings. So your EPS is divided into two parts. If you want, I'll just put it up over here. EPS will have two parts: dividend and retained earnings. Retained earnings. So if a company is having an EPS of 15 rupees, it can distribute 8 rupees as dividend and balance 7 rupees it can keep as retained earnings for future. Please note down objective and applicability. Then I will discuss something else. Let us go ahead. Now, sir, why this formula is that important? Let us understand that also. Why this formula?
Hello, sir.
Yes, Dikshit.
Sir, it's generally minimum. How much is there in share company has taken the EPS?
What?
Is there, for example, you say minimum company has their EPS as 12%, 12 rupees. So I said like that.
What is your doubt?
I doubt in general question, sir.
What it is? What is the general question?
If you say before that my company has their 12 rupees as there in EPS, so what is the minimum as there?
Sir, there is no minimum or maximum. You please reduce the speaker. Because I can hear my voice only two times. See, EPS, there is no minimum or maximum. EPS is completely depending on what profits the company has earned. So your question is not valid, sir. A company can have 1 rupee EPS also, it can have 1,000 rupees EPS also, depending upon the performance of the company. So I cannot answer you that. What is the minimum EPS or maximum EPS? A company can have negative EPS also. Negative EPS as in it has a net loss. So net loss divided by the total number of equity shares will give you a negative EPS. Right? So let us go ahead now. Yes, Sujit.
Sir, good evening, sir. Am I audible?
Yes, you are.
Sir, is there any sole authority to guide matters regarding EPS apart from calculation which is done said in AS 20?
Can you please repeat?
Sir, what I meant to ask was, is there any sole authority to regulate EPS policies of a company?
Sole authority?
Yeah.
Sir, we have an accounting standard. So IC has already given you the standard. You have to follow it.
Sir, it's about calculation, right?
Sir, calculation are also given by AS 20 itself. So you have to follow the same calculations which you are going to learn now. If you don't follow, nobody is going to come and check. But if you are not following, your EPS only cannot be properly compared with the others.
Yes, sir.
ICAI doesn't have the machinery whether you are following or not. Your auditor will definitely raise a question that you are not calculating EPS correctly. Now, why this formula of EPS is that important? See, to make the importance of EPS, I would also like to put a light on one more formula, P ratio. P ratio is nothing but price earning ratio. Price to earnings ratio means how much market price an investor is willing to pay for a particular earnings of the company. How much an investor is willing to pay to buy a particular share on the basis of its earning. is what price earning ratio will tell you. Now, if you see the formula is market price per share, which we call it as MPS. Market price per share divided by earnings per share is the formula. So let us put a numerical figure. Assume market price is 100 rupees and your earnings per share is 10 rupees. So you get an answer at 10 times. Now, what is the logic of this 10 times? So 10 times means an investor is willing to pay 10 times the EPS as the market price. The investor is willing to pay 10 times of the EPS as the market price to buy out that share. And you can also see I've put the formula for market price also over here by just simply changing the left hand side and right hand side. Market price is equal to price earning ratio multiplied by EPS. So sir, I'm concluding one thing over here, that EPS plays a major role in determining the market price of a particular enterprise, of a particular company. That is why calculation of EPS should be properly done. EPS will help you to derive the market price of any company. Just multiply its PE by the earnings per share. Your market price should be equivalent to that. And one more point to remember, a company with a higher PE ratio, a company with a very high PE ratio will have a very high market price. Company with a PE ratio, I'm not going into detail because you're going to learn this in financial management ratio analysis topic. My point here is just to make you understand why EPS is important. Because I'm not discussing financial ratios over here. My simple point is EPS is a base for working out the market price of a company. So EPS has to be correctly calculated. P ratio is nothing but the price an investor is willing to pay with respect to the earnings. Or in simple terms, how many times of EPS an investor is willing to pay for the share is PE. So if the P ratio of a company is 80 times, so an investor is willing to pay 80 times of the EPS to buy that share. But sir, having such a high P ratio is never advisable. Never invest in a company with such a high P ratio. 100, 150, 180 P. Sir, always invest in a company with a P ratio of 15, 20, maximum 30 or 40. Once the P ratio is crossing beyond 40, 50, 80, 100, means it is in an overbought zone. Means the fundamental of the company is not strong. Unnecessary demands are created for it. A company with a very good fundamentals will have a P ratio ranging between 15 to 40 or maximum 50. So very high P ratio company is not at all advisable for investing. So your EPS plays a major role in determining the market price of a share. That is why we have made a specific standard for this. So if everybody calculates the EPS properly, then the market prices can also be derived correctly. Plus, an investor can take a proper, prudent decision. Right? So let us go ahead now. Sir, there are two types of EPS. Basic EPS, diluted EPS. Today, I am not starting with diluted EPS. Keep diluted EPS apart. Today, we will be talking only about basic EPS. And sir, basic EPS is the actual EPS of the company. Diluted EPS is just a presentation given to the shareholders. So why this presentation of diluted EPS is given, I will talk about it later. Right? Today, I will talk only about basic EPS. And once more, I am repeating, basic EPS is the actual EPS of the company. So whenever a person says that the EPS of this company is say 50 rupees. So please understand that 50 rupees is the basic EPS. Right? So let us have a formula of the basic EPS. What is the formula? I think I will not be using the landscape mode now because a lot of content is to be shown. So I would request you people to please zoom in your devices and copy the things accordingly, because then I have to show many things, right? So I would request you people to zoom a particular part in your screen. Right? Now, what is the formula of basic EPS? Sir, the formula goes this way. Net profit attributable to the equity shareholders. Net profit attributable to the equity shareholders, which is the numerator, divided by weighted average number of equity shares. Weighted average number of equity share, in shortcut we call it as WANES. WANES. Now, why there is a weighted average taken, we'll be talking about it in the later next 5 to 10 minutes. But let us first understand how to calculate the numerator. That is net profit attributable to the equity shareholders. That is the first point we'll be discussing. I want everybody to please copy down the P ratio formula and whatever I have written up to here. Please copy down till here. Now, I hope you have copied down this point. Now we'll go for the first part, that is how to calculate the numerator. And trust me, in exam, the net profit attributable to the equity shareholders will always be given. 99% questions it will be given. In 1 or 2% questions, you have to calculate the net profit attributable. So how to calculate it? Sir, I have made a format of the profit and loss account in a vertical form. Right? And this is how you are going to work out the net profit attributable to equity shareholders. Don't copy anything which is written over here. Don't copy it, is all different. You just have to check this angle. Net profit attributable to equity shareholder. How it will be calculated? Sir, we'll always start with EBIT. That is earnings before interest and tax. From here, we will subtract the interest payable. That is interest on loan, interest on debentures. Once you subtract the interest, whatever you get is called as EBT, earnings before tax. From the earnings before tax, now you will adjust as per AS5 prior period items and extraordinary items over here. Plus or minus. If it is a income of, if prior period item is in the form of income, add it. If it is in the form of expense, subtract it. Same with extraordinary items. Once you adjust these items, you will get earnings before tax after prior period and extraordinary items. From EBT, now we will subtract the taxes payable to the government. Once your taxes are subtracted, next part you will get is called as earnings after tax. EAT, earnings after tax. From the earnings after tax, now you will subtract the preference dividends if payable. So if you're having some preference dividend, and I might already be aware that preference dividend, or I would say the preference shareholders has a preferential right in payment of dividend. So first to them we will pay off their dividends. After that, whatever profit is now left is called as net profit attributable to the equity shareholders. This final figure is called as net profit attributable to the equity shareholders. And in this manner, it has to be calculated if asked in exam. But 99%, the final figure, that is net profit attributable to the equity shareholder, will always be given in the question only. Right? EBIT is earnings before interest and tax. EBT is earnings before tax. PAT is earnings after tax. So please copy down the format of the profit and loss account that you have to draft in exam if net profit attributable to equity shareholders is to be calculated. But as I told you, 99% this will be given in the question itself. So please take a note of this. I'm giving you around 3 to 4 minutes. Please note down.
Now we'll go for the next part. That is, yeah, you can also say yes. Numerator is also similar to your divisible profits, but no, sir, not exactly, because divisible profits are generally after transferring to reserves. What is divisible profit? Divisible profit means the profit left over after transferring it to the reserves. So I would not say 100% it is divisible profit is correct. We would say that net profit is attributable to equity shareholder, means on this profit only the equity shareholders have a right, because rest all we have paid. See, we paid the interest, so debenture holders are done. We paid the taxes, government is done, and we paid the preference dividends, so preference shareholders are also done. So now whatever profit is left behind, purely and purely it is with respect to the equity shareholders. Right? Now, let us go for the calculation of the denominator. Now, sir, in your financial management, FM, the formula that is used for what we say, the formula that is used for calculation of EPS is actually simple. The formula over there is EPS is equal to NP for same NP attributable to the equity shareholder, that is why I've written in short, NP for equity shareholders divided by number of equity shares, right? But in accountancy, don't copy this formula. Don't copy this formula. This is your FM formula. But in accountancy, what formula is given? Weighted average number of equity shares. Now, sir, why we have to do weighted average over here? Sir, please understand. A shareholder will be having a right in the profits on weighted average basis. Weighted average basis means on time basis. Means if a particular shareholder is holding shares of a company for 1 year and another shareholder is holding the shares of the same company for a period of only 6 months, can technically both have the same rights in the net profit? Can technically both have the same rights in the net profit? The answer is no. Because if a person has held it for 1 year, so technically he should be aware his rights is for the full year's profit. But on the other hand, if a shareholder has held the shares only for a period of 6 months, so technically he should be having the rights only for 6 months only. Are you able to get this point? So to figure this out, we are using weighted average number of shares. And sir, the weights considered over here is nothing but the time factor. Right? Now, first statutory warning. Don't ever think for calculation of weights with respect to an investor. Right? Always think from the company's point of view, because this is a major area. This is an area where majority of the students make a mistake. Now, sir, as I told this now, if a shareholder has held it for 6 months, so he should have a right in the profits for a period of 6 months only. That is absolutely correct. Now, people try to relate it with the share market. And people say that, sir, if I purchase shares of Reliance in December, so December to March, I hold it for 4 months. So means I should be getting dividend only of 4 months. Sir, here I am not at all talking about the shares of the stock exchange. Sir, please understand, the shares in the stock exchange that you are dealing are already issued by the company in the IPO or FPO so many years back. So think from the company's point of view. From the company's point of view, all those shares are outstanding for full 12 months every year. Only the ownership gets changed because of the stock exchange. Right? So technically, each and every share is eligible. Each and every share is eligible for the full year's profit only. Right? Now, if you sell and purchase a share from the stock exchange, that has got nothing to do with the weighted average number of share calculation. Right? Now, if, for example, Reliance has some, say, 15 crore equity shares trading in the market. So technically, these 15 crore equity shares were issued by Reliance way back in the form of IPO or FPO. Right? And Reliance doesn't care whoever is changing the ownership every day. For Reliance, these are the share issued to the general public. Now, if general public is shifting from one person to another person, that is not the consideration of Reliance. Reliance will say that I have already issued my shares, so these are my number of shares outstanding. Right? So don't ever take a wrong logic from the share market point of view. That, sir, in share market daily basis, the shares are transferred. So how will you calculate the weighted average? Sir, please understand here, share market, whatever transaction you are doing, that is from one investor to other investor. But think from company's point of view. Company has already issued those shares. So for company, it is outstanding for full year. It is outstanding for full year. I hope you are understanding this point. Now let me go for the calculation of Vains. Now let me make you understand why we are doing weighted average number. Now what it is written, Vains is calculated by using the time factor as the weights. We are using the time factor as the weights over here with only one reason, that a particular equity share will have a right in the profit for only the period for which it was outstanding during the year. I will write this point over here. An equity share will have right in the profits only for the period it's outstanding during the year. Right? So, and why is this done? I will tell you that also. Sir, when I say EPS, earnings per share will be only one figure for all the equity shares that are outstanding for the company. Right? You will not have different EPS figures for different equity shares issued by the company during the year. We will have only one EPS figure. You cannot have multiple EPS figures. So whatever adjustments have to be done will be done for the equity shares on time basis. Now, please understand with the help of this example over here. I will solve this example once again for you. I'll just rub this off. So once I'm solving this example, then you will exactly come to know why have I done the weighted average. Please understand. Sir, there is a company called as XYZ Limited. Fine. And in this company, we have only two shareholders, sir. For example, only two shareholders. Sir, one is Mr. X, who is having 1,000 equity shares as on 1st April 2019. And another shareholder is Mr. Y. Sir, he also has 1,000 shares, but sir, he got it from the company on 1st October 2019. Correct? So technically, Mr. X is holding these shares for one full year. That is from 1st April to 31st March. On the other hand, Mr. Y is holding these 1,000 shares only for a period of 6 months. Correct? So do you think both of them should have equal rights in the net profit or not? Sir, they should never have equal rights in the net profit. Am I correct? So I have to calculate the EPS in such a way that whatever is their rights in the shares, rights in the net profit, only that much part of profit should be made available for them. Yes or no? Okay. Now I say the net profit earned for the equity shareholder for the year was 20,000. Correct? Now, if I don't take weighted average number of shares, my calculation of basic EPS will be 20,000 net profit divided by total 2,000 equity shares. That is your FM formula. I will get an answer of 10 rupees per share. So technically, Mr. X will get 10 rupees per share on his 1,000 shares. So Mr. X will overall get 10,000 rupees share in profit. And Mr. Y is also getting 10,000 rupees share in profit. Now, can I say, if I go with this, it will be a pinching factor for Mr. X? Mr. X will be having a pinching effect. Mr. X will say, I held the shares for 1 full year and you are giving me 10,000 EPS total. That is 1,000 shares by 10 rupees. That is total 10,000 EPS. And Mr. Y held the shares only for 6 months. His shares were outstanding only for 6 months. And to him also, you are giving 10,000 rupees EPS. Can I say it is not correct? It is not fair. Correct or not? So that is the only reason why we will be doing weighted average. Weighted average means we will be considering Mr. Y shares outstanding for a period only of 6 months. Means if I do it for 6 months, means technically Mr. Y will get the rights in EPS for a period of only 6 months. Now say how? So let us calculate veins now. Sir, with respect to X, with respect to Mr. X, I would say, sir, he has 1,000 shares. And can I say these 1,000 shares are outstanding for full 12 months? Outstanding as in they have been issued for full 12 months, multiplied by 12 upon 12. So I am getting an answer for Mr. X that he will have full 1,000 shares rights in the net profit. Right? Means full rights in the net profit. But sir, when it comes to Mr. Y, Mr. Y also has 1,000 shares. But can I say that outstanding only for a period of 6 months? So multiply it by 6 by 12. It means with respect to Mr. Y, he should be having the rights of getting EPS only with respect to 500 shares. And now it will be fair means of calculation. Now, if you see the total number of shares, these are called as the weighted average number of shares, are 1,500. So now my basic EPS will be calculated as per 1,500 shares. So therefore, my basic EPS will be 20,000 profit divided by 1,500 shares. We get the answer as 13.33. So 13.33 is the earnings per share on the basis of weighted average number of shares. Now, please further understand for a minute. I'll give you time to copy, not to worry. Please understand for a minute. Now, when I say the total EPS of Mr. X, I will say he is having 1,000 shares and per share our EPS is 13.33. So Mr. X is overall earning 13,333 as the total earnings for all his equity shares. Correct? Now, Mr. Y, his EPS is 13.33. As I told you, the EPS figure for the full enterprise will remain the same only. You cannot have different EPS for different shares. Even if the share is held for 6 months or it is held for 1 full year, the figure of EPS will be same. Only the shares will be taken as what? Weighted average. So technically, Mr. Y will have the right of 500 shares only. I'm sorry, I wrote 5,000. I'm sorry. For 500 shares only. Right? So he will be having a total earnings of 6,667. And now can I say this is fair means? So this is the only reason why we consider weighted average number of shares. And sir, one technical point I will say, please try and understand this. Sir, this is very much technical. Sir, generally, weighted average number of shares of a company for almost all the financial years are exactly the same. Unless no new equity shares are issued by the company. See, if I say that a company has issued in the market overall 1 crore equity shares. So can I say every year that 1 crore equity shares are only outstanding? Yes or no? So the weighted average number of shares will be equal to 1 crore only. Right? But if I say that in one of the year, a company has issued 25 lakh fresh equity shares. So can I say new 25 lakh shares are coming? So technically in that year, their veins will change because 1 crore is outstanding for full year. So that you will be doing 12 by 12. But these new 25 lakh shares might have been issued, say, on 1st August. So for that year, they are outstanding from 1st August to 31st March. So technically, they're outstanding for only 8 months. So we'll be doing 25 lakhs into 8 by 12 for that year. So your veins will be different. But sir, in the next year, can I say that 25 lakh shares will also now be outstanding for 1 full year? So from next year, your weighted average shares will be how much? Pura 1 crore 25 lakh shares. So technically, every year the veins is same only. The veins will differ in the year in which, only in that year in which new shares come in. Right? Only for that 1 year, you will have a different veins. And after that also, your veins will be again same because all your shares will be outstanding for 1 full year. So please note down this example. First, you note down about veins and then you note down the example. First, you note down the veins and then you note down the example. Yes, Aparna.
Sir, in this example, we have calculated weights based on the number of shareholders. That is, we have taken into consideration the duration they've been holding the shares of the company.
Right. And that is the only factor we have to follow, time factor.
But how will huge companies, like say you gave Reliance example, which was 15 crores and all, how will they calculate veins? On what basis? Because there'll be lots and lots of shareholders.
Madam, shareholders may be crores. No problem with that.
And their
But
duration
number of equity shares. See, you're again getting this wrong. Is Reliance issuing fresh equity shares every year?
No.
Sir, you are trading the existing equity shares through the stock exchanges. I explained this point earlier also. I think you're again going in the wrong direction. See,
no, I did get
company,
it then, but after the example,
I think you are not technically sound of stock exchange. That is why you did not understand. See, technically, I'll tell you one thing. If I say that, let us take Reliance. Now, when you buy a share of Reliance from the stock exchange, do you think Reliance personally issues a new equity share every time you buy it from the market?
No, it's already available.
It is already available. Means it is already outstanding from the company's point of view.
Yes.
Only the shareholders change. The share remains the same. Only the holder change. Right? So technically, that share is outstanding from so many years.
Okay.
Reliance had first come up with its IPO somewhere in the year 1978 or 1980. 1975, if I'm not wrong. So technically, from 1975, those shares are still outstanding and we are trading between them.
Okay. So
please understand, this has got nothing to do with stock exchange. So stock exchange, just the shareholders change. It is never like that. When you are taking a share from the stock exchange means a company is issuing a fresh equity share for you. If that is the case, then calculation of veins is not possible only. It will not be possible at all.
Okay, so only the new issue of shares by a company would affect the EPS.
Exactly. New shares, if they are coming. And now say, for example, company has now Reliance had issued some right shares in the month of August. So this year they will have to calculate their veins separately because they have some existing shares plus fresh equity shares also coming. So they have to calculate their veins.
So the EPS for all those existing shares would remain the same.
EPS has to be calculated every year.
Okay.
You people are not technically sound, it seems. You people go in a very wrong direction. I'm not. You're completely going in a wrong direction. See, EPS is earnings per share. So every share which is outstanding of the company, you are calculating the earnings on them. Right? That is the prima facie part of this chapter. Right? A company issues shares through initial public offers, IPOs or FPOs, that is further public offers or right issues. Right?
Yes, sir.
Once the company has issued the shares, means that shares are outstanding by the company.
Yes.
Now in the market, Mr. X buy it, sell it to Mr. Y, Mr. Y sell it to Mr. Z. Company has got nothing to do with it. Nor my EPS calculation has got nothing to do with it. For me, what is important? How many shares are outstanding? Sir, I have totally issued in the form of IPO, FPO rights, total 5 crore shares. So I will consider 5 crore shares for my EPS. That's it. Now, these 5 crore shares are transferred 50 crore times by n number of people. I've got nothing to do with that. Because for me, there are 5,000 shares only and people are trading in these 5,000 shares only. No new shares pop out unless I don't issue them.
Yes, sir.
Right? So when the new shares are coming in, when the company is again coming with a further IPO or company is further issuing fresh equity shares, then your Vains calculation will be again changed because new shares are coming in. If the existing shares are there, they will always be multiplied by 12 by 12 only because they will be outstanding for full year only.
Yeah, yes, sir. Okay.
So when the new shares come in, only for that particular year, you have to do that 6 by 12 or 8 by 12 for whatever time period is outstanding.
Okay.
But from
okay.
second year onwards, can I say it will be outstanding for full 12 months only?
Yes, yes, sir. Yes.
So technically, the calculation of Vains changes only in the year in which the new shares have been issued.
Okay.
You can understand with this example. See, it is consuming my time, but fine, you have to understand the concept. See, on 1st April, no, it will not take 1st April. Say on 1st October, company issued 5 lakh shares. So what will be the Vains of the company? Sir, Vains will be 5 lakh shares for a period of 6 by 12.
Yes,
Because
sir.
it is issued on 1st October.
October.
So 2,50,000 is the Vains. Right? So this is 1st October 2018. So this is financial year 18-19. Right? But now when I come to financial year 19-20, can I say these same shares will be outstanding from 1st April now?
Yeah.
So from 1st April, I have having 5 lakh shares. So now
Yes,
what
sir.
will be my Vains? Sir, my Vains will be 5 lakh only. That is 5 lakh multiplied by 12 upon 12. So it will be 5 lakh only.
Okay. Got it.
So technically, when the new shares come in, then only the Vains change. Or the
Okay.
Vains generally are equal to the number of shares which are already outstanding because those shares are outstanding for a full 12 by 12 months. So 12 by 12 automatically gets cancelled.
Okay. Thank you.
Right? I hope you have copied down the example. Let us go ahead now. Yes, Mr. Singh. Okay. Now let us go ahead. Aparna, please lower your hand. Now, there are some situations where the shares are issued. So you have to consider the timings from where it has to be considered for calculating the Vains. And for this, you have to open the JKSC material. And JKSC material, it is on page number 111. Please open up page number 111 of the JKSC material. There is one table that you can find on page number 111 and 112. And this is a very, very important table. And the reason behind this is, so this table has come in exam. Now what this table is telling you, Sir, this table will be helpful for calculating the Vains. Means these are the various types of shares or various situations in which you are issuing the shares. So what should be the time factor, or from when should the time factor be considered for the purpose of calculating the weighted average number of shares? Now, please understand the first situation. Equity shares issued in exchange of cash means you are issuing fresh equity shares in the market for cash. So if that is the case, from what date it should be considered as outstanding in the firm? Sir, it is the date of cash receivable. Or I would simply say date of cash receivable is nothing but, you can say, the date of issue. Right? So this date of issue will be given in the question. Means if they say that a company has issued 1 lakh equity shares for cash on 1st July. So from 1st July to 31st March, it will be considered as outstanding. So your Vains will be calculated from 1st July to 31st March, which is a period of 9 months. So whatever 1 lakh equity shares multiplied by 9 upon 12 will be your Vain. So basically this table is telling you how much should be the time factor to be considered. Second point, equity shares against conversion of debt. Means you are converting your debt into equity. So if you are converting your debt into equity, from the date of conversion, you will consider the time factor for weighted average. Means if debenture is converted into equity on 1st December, so technically equity shares come in on 1st December. So December, January, February, March, 4 months only they are present. So their weighted average will be calculated on the basis of 4 upon 12. Means they are outstanding in the current year for 4 months only. So 4 upon 12 will be the time factor. Point number 3. Equity share against interest or principal of any financial instrument. Means you are issuing equity shares of your company to settle any interest part or principal part of an outstanding amount. Means to settle any loan or to settle the interest component of the loan. You are issuing your equity shares. So from what date it should be considered outstanding? Sir, it is the date when interest ceased to accrue. Now, please understand, date when interest ceased to accrue means the date from which interest will not be charged by the bank. Now, technically, from where the interest will not be charged? Sir, the day when you issue the shares. Because when you settle their principal, they will not charge you interest. So what will be the date? Sir, date of issue of shares. In simple terms. Now, my sincere request to everybody, when I'm explaining a particular point, please don't send chat messages. Now I'm explaining the third point. Some person is sending me a chat message. Please explain the second point. Now, if there was a network issue, I can understand, because we are having an online class, so network issues may be there. But if there is a network issue, hold. Where I said I will not explain. But I'm explaining one of the point and you are sending me a chat message that distracts. And I think I've told this at least 3 or 4 times before also. So now you take this as my request or you take as a warning. Don't send chat messages when the explanation is going on. Right? When the explanation is completed, then you are free to use the chat box. Or else I'll disable the chat box only then. So please have that courtesy. Because what happens now, when you send a chat, it pops out. And unnecessarily, the mind gets diverted over there. So if you have a network issue, hold. No problem. After the point is completed, you can raise your query accordingly. It will be solved. And I think I've not ignored anybody's query. I've solved almost 99% of the queries. 1% may be missed out because so many chats come in. But 99% people's queries I have solved. So please, don't send chat messages when explanations are going on. So point number 3 says, equity shares issued against interest or principal of any financial instrument. They say date when interest ceases to accrue. In simple terms, I will say the date of issue of shares. So from the date when the shares are issued, from that day you consider them as outstanding for the purpose of Vains calculation. equity shares issued in exchange for the settlement of a liability of the enterprise. So you have a liability, means you may have a debtor, you may have a creditor, or you may have some bills payable. So to settle them, you are issuing shares of your company. So from what date the shares should be considered for Vains? Date on which settlement becomes effective. So when the settlement is effective, now please understand this technically. When will the settlement be effective? Technically, when will the settlement be done? Sir, when you issue the shares. Technically, when will be the settlement done? When you issue the shares. So the date of issue only will be applicable over here also. Right? Equity shares issued in consideration of acquisition of assets other than cash. Means shares are issued for consideration other than cash. You have already learned this in CA Foundation. Shares issued for consideration other than cash. In such cases, from what date the shares should be considered as outstanding? Date on which acquisition is recognized. Date on which acquisition is recognized. Acquisition recognized means when the asset is recorded in the books. So the date on which you record the asset in the books, technically on that day only you will issue your shares, because your journal entry will be asset account debit to equity share capital account. Yes or no? So technically the date of recognition of the asset and date of issue of shares will be one and the same. When next point number 6, equity shares issued against services rendered, means you have rendered some services, or I'm really sorry. You have taken some services, against that you are not giving payment in cash, you are issuing shares of your company. That is also possible. So you took some services from particular person and now you are issuing shares of your company. So from what date the shares should be considered outstanding for that year? When the services are rendered, the date when services are rendered. So say for example, if the services are rendered in the month of November, say in the first 10 days of November, the services are rendered. So technically the share should be considered as issued from the first 10 days of November. So we can take 1st November also. So November, December, January, February, March, 5 months the shares are outstanding. So when calculating the Vains on these number of shares, we'll do 5 by 12. Right? And I'll repeat one more time. Why are we doing Vains? Why are we doing weighted average? Sir, we are doing weighted average only because every equity share cannot have the full right in the profits. You will have full rights in the profit only if the share was outstanding for full 12 months. If a share was not outstanding for full 12 months, how can that equity share get a full right in the profit? Yes or no? We'll take an example of debenture only. Just take a loan of simple loan. If I am giving you a loan on 1st April, so can I say I will get the interest for full 12 months from you, that is from 1st April to 31st March? Yes or no? But if I give you loan on 1st January, right, and I demand the interest for full 12 months, will you give me? Will you give me? No. You will say, sir, your loan is outstanding for 3 months only. That is January, February, and March. So technically, you should get interest only of 3 months. Same logic applies with shares also, sir. If your equity shares are available in the company only for a period of 4 months, so technically they will have rights in the net profit only for a period of 4 months. And this rights for 4 months, we calculate in the form of weighted average number of shares. So what we do is multiply by those number of shares directly by 4 upon 12. So if I have 1,20,000 shares, so 1,20,000 shares into 4 by 12 means only 40,000 equity shares rights I will get for profit. Means when the EPS will be given, I will be getting it only for 40,000 shares, not on full 1,20,000. Because my shares are outstanding only for 4 months. Right? Then, partly paid up equity shares, I'll be completely doing this separately with an example. So please hold for the time being. Right issues also hold because adjusted with right factor. This is a complete concept which will be done tomorrow. So these two things, please hold. Now, equity shares issued as consideration in amalgamation. Now, I think amalgamation topic is not started to you people. So I'll not go in that detail. I'll just say that, sir, amalgamation is nothing but one A company takes over B company, right? And B company is liquidated. And A company will now do the business of B also. That is called as amalgamation. The best example of amalgamation was Bank of Baroda, Vijaya Bank, Dena Bank. Vijaya Bank and Dena Bank was completely absorbed by Bank of Baroda. And now Vijaya Bank and Dena Bank are no more into existence because Bank of Baroda has taken their complete business. So I can say that Vijaya Bank and Vijaya Bank and Dena Bank both got amalgamated to the Bank of Baroda. So if amalgamation takes place, there are two methods of amalgamation: amalgamation by way of merger and amalgamation by way of purchase. Amalgamation by way of merger means entire company will get merged as it is with the purchasing company. Means the selling company will as it is merged with the buying company. Each and every asset, each and every liability of the selling company will be merged with the buying company. So technically, when amalgamation takes place, shares are given to settle the payment. Means Bank of Baroda might have issued shares of Bank of Baroda to the shareholders of Dena Bank and Vijaya Bank to settle their claims. Right? So for Bank of Baroda, new shares are getting issued because of amalgamation. So for those new shares, what should be the time factor to be considered for the purpose of Vane's calculation? Are you understanding my point? Bank of Baroda has issued shares to the shareholders of Dena Bank and Vijaya Bank because now those companies are purchased by Bank of Baroda. So Bank of Baroda has paid the purchase consideration in the form of shares. So for Bank of Baroda, new shares have been issued. So what should be the weighted average for those shares? Here they say shares included in the calculation of weighted average should be from the beginning of the reporting period. Beginning of the reporting period means from 1st of April. Even if the shares are issued in the case of amalgamation on 1st October, still it will be considered as outstanding from 1st April. That is for full year. And the only reason is what, merger method. Merger method means, I already told, the selling company's entire balance sheet gets merged with the purchasing company. So technically, even if the shares are issued in October, they will be considered as outstanding from 1st of April. The reason is entire balance sheet gets merged. Means whatever the selling company has done in the month of April, May, June, July, whatever they have done, that results also get merged with the buying company. So what will buying company say? It is as good as outstanding for the full year because that entire company is getting merged with you. So their entire balance sheet gets merged. That is why they say that the shares will be considered as outstanding from the first day of the year. That is from 1st April, full 12 months. But then in the case of purchase method, if it is the purchase method of amalgamation, here we buy out the company, but not all the assets and all the liabilities are settled. Some assets and some liabilities will be left over with the selling company only. They will sell their assets and they will settle the liabilities. In that case, you will not consider the shares outstanding from the first day of the year. You will consider the shares outstanding from the date of acquisition. Date of acquisition means the date when you acquired that company. So when you acquired that company, you will issue the shares. So technically from the date of acquisition, you will consider the shares to be outstanding. So if the acquisition takes place on 1st October, the shares will be considered as outstanding from 1st October to 31st March. That is 6 months period. If it is purchase method. But if it is merger method, even if the shares are issued on 1st October, they will be considered as outstanding from 1st April only. And these all are asked as theoretical points in exam. In practical questions, these points are not asked, but for theoretical questions, they are asked. And this table has been asked already in exam once. Now, the last point, bonus shares. Bonus shares. shares included in weighted average from the beginning of the reporting period. Means, sir, for bonus also, whenever the bonus is issued, that is not a point. It will always be considered as outstanding from the first day of the year. The simple reason is, sir, from where bonus is given? Sir, bonus is given from the reserves. I can also say that bonus is nothing but capitalization of reserves. Capitalization of reserves means transferring your reserves to share capital. That is what is capitalization of reserves. And can I say the reserves are outstanding from the first day of the year? So technically only the reserves gets transferred to share capital. So technically the shares are outstanding for the one full year only. So whenever it is a bonus issue, always remember the shares are considered as outstanding for the full year. For the full year. Now, from the exam point of view, in practical question, bonus comes, right issue comes, partly paid up shares point come, settlement of, that is conversion of debt into equity comes, and equity shares issued for cash. Only 1, 2, 3, 4, 5 points can be asked in a practical question where you have to solve and calculate the weights. Rest all whatever we have learned only comes in a theoretical point. Because on the rest all things, in the rest all things, practical questions don't arise. They ask it only for theoretical points. Right? So we'll just recap the points which are going to come in our questions now. So if the shares are issued for cash, you will consider it outstanding from the date of issue. If there is a conversion of debt into equity, you will consider the shares outstanding from the date of conversion. For partly paid up shares, I'll talk about it now. After some time when we start an example, right issue, we'll be doing it tomorrow. For bonus shares, always consider them as outstanding from the first day of the year. Right? So now I will be solving some examples where we will be learning the calculation of weights of different situations. I'll be solving around 4 to 5 examples now. Right? So after these examples, you will be very much clear with the calculation of weights. Right? So let us start with the examples now. Now, this is the first example. Right? And we have to calculate weights. Now, what is the example over here? Please understand. On 1st April 2018, we have 50,000 shares of face value 10 rupees. On 1st April 2018, we have 50,000 shares outstanding as the opening balance. I can say these are the opening balance of shares. Face value is 10 rupees. On 1st October 2018, 30,000 new shares have been issued for cash, which are fully paid up, of rupees 10 each. So technically, the shares which are there in the opening balance and the shares which are issued new, both are having the same face value. Because if the face values are also different, it creates a problem. Because you will only technically understand a share with a face value of 10 and a share with a face value of 6 rupees cannot have the same rights in the profit. Yes or no? Right? So again, the calculations will be different. That is that partly paid up point. We'll discuss it later. On 1st December 2018, 10,000 bonus shares have been issued. Correct? And on 1st January 2019, 5,000 shares are bought back. That is a buyback of shares happening. Now, please understand, buyback is done always from the old equity shares, not from the fresh equity shares issued. So technically, these 5,000 shares are bought back from these 50,000 shares. Right? It is not bought back from the new shares or from the bonus, because bonus and these new shares are issued in this year only. So they cannot be bought back immediately. So buyback will be done of the old shares. And you have to calculate Vains. Now, I want everybody to please focus for 2 minutes. Once I solve this, I'll give you 5 minutes to copy. Right? Please focus. Calculation of Vains. Now, sir, on 1st April 2018, you have 50,000 shares outstanding. Right? Always calculate individually. Don't go for cumulatively. Because if you go cumulatively, that creates a problem. Always go for individual one transaction which is given. Now, let us first talk about these 50,000 shares. Can I say these 50,000 shares are outstanding from the first day of the year? So they are practically available for the full 12 months. So for their weighted average, I will be directly doing 50,000 multiplied by 12 upon 12. So they will be full 50,000 shares only. Means technically they have full rights in the profits because they are available for full 12 months. Correct? Now, sir, on 1st October, 30,000 new equity shares are issued. So can I say these 30,000 new equity shares are available in the company only for a period of 6 months for this year at least? From next year, that is from 1st April 2019, they will be available for full year. For this year, they are available only for a period of 6 months. So they will not have full right in the profits. They should have right in the profit only for 6 months, right? So for their weighted average, we will do 6 upon 12. So technically, they will have rights in the EPS for 15,000 shares only. Because they are not outstanding for the full year, they're outstanding for a period of 6 months only. Right? This will be added up over here. Sir, then comes the bonus part. Sir, 10,000 shares are issued as bonus. Now, can I say bonus will be always be outstanding for 12 months? Even if the bonus is issued in the month of December, it will always be considered as outstanding for the full year. Because bonus is nothing but capitalization of reserves. And sir, reserves are always available with you from the first day of the year. So you're just transferring your reserves to share capital. So they will be considered as full 10,000 shares. Right? Now comes the last part, that is buyback. Sir, buyback means the owners of the company, the promoters of the company buys back the shares from the market. And one of the reason is the owner or the promoter wants to increase their shareholding or they want to increase their stakes. That is why they buy out their shares only from the market. Right? Now, when the company is buying back their shares, some company, what they do, they buy back, right? And they cancel those shares because they don't want extra equity shares to be issued in the market. Now, please understand, when the buyback is done, so technically these 5,000 shares are no more outstanding. These 5,000 shares are no more outstanding. For what period they are not outstanding? January, February, and March. Till from April to December, they were available. From April to December, they are available, and we have already considered these 5,000 shares in these 50,000 shares. Yes or no? So technically, these 50,000 shares we have taken outstanding for 12 months. But can I say out of these 50,000 shares, 5,000 shares are bought back? So they are not available for a period of 3 months, that is January, February, and March. So what I have to do? Shall I add it or I will subtract it? I will subtract it. I will subtract the buyback. So I will subtract 5,000 shares which are not available for a period of 3 upon 12. So I think the answer comes to 1250. 1250 will be subtracted. So now we get our final answer as 73,750 equity shares, weighted average number of shares. So we have 73,750 weighted average number of shares for the purpose of calculation of weight. For the purpose of calculation of EPS. Right? Now assume if net profit given in the question was 15 lakhs. Assume. So therefore, your basic EPS would have been 15 lakh rupees divided by 73,750 equity shares. So 15 lakh divided by 73,750. So your EPS is 20 rupees 20.34. Your EPS is rupees 20.34. Right? So these shareholders will get 50,000 into 20.34. These shareholders will get 20.34 into 15,000. Bonus will get same 10,000 into 20.34. And this 1250 will be deducted from this 50,000. So technically these people will get how much? 48,750 shares. EPS for 48,750 shares. Because this 1250 is a part of this only which is bought back. And the total will come to 15 lakhs only. So please copy down this. Please copy down this.
Yes, Harshita.
Sir, you said that the company will buy back the shares, no, sir? They will buy back at market value only, sir. Market value of the shares.
That depends upon the company.
Oh.
Give an example. TCS, Tata Consultancy Services, had done a buyback around 1.5 months back. They bought it for 3,000 rupees per share. And the market price was, I think, 2,858 that time. So technically, the buyback offers are higher than the market price. Then only you will offer it now. If they are offering
Yeah.
at lesser price, then you will sell it in the market. Why will you sell it back to the company?
Right, sir.
So they have to give some lucrative offer.
Okay, sir. Thank you, sir.
You have an entire chapter of buyback in your accounts. I think it is an advanced accounts. You have an entire chapter, buyback of equity shares. So you'll be learning the concept of buyback in detail over there. For us, only one point is to be noted. While doing the calculation of gains, buyback has to be subtracted. Because these shares are no more outstanding now. Yes, Ritika.
So, for the second point of the question, 30,000 shares issued for cash fully paid up for rupees 10 each, no, sir. Then you have done the calculation is 30,000 into 6 by 12. How is that 6? Couldn't understand that 6, sir.
Madam, what is the time? Calculate the time period from 1st October to 31st March. How much it is?
Okay. Yeah.
Right? It is time factor, and I'm repeating these words from so many times. For what time period it will be outstanding? From what date you will consider it as outstanding? So if it is issued on 1st October, so 1st October to 31st March, it is a span of 6 months. So it is outstanding for 6 months.
Oh, actually, I calculated wrong, sir.
Okay. Yeah, it is possible. The date of acquisition of assets differ from the issue of shares. But okay, sir, it is not none of your business in that case. You just have to answer it theoretically. Don't go into much technicalities because you have got many things to be understood in technicalities. Copied. Please do it fast. Sir, you have entire chapter called as amalgamation and you have an entire chapter called as consolidation, where you will be learning in detail. In simple terms, consolidation means holding and subsidiaries balance sheet is merged. That is called as consolidation. Consolidation of financial statements. Holding company and subsidiary company, both companies' balance sheet merged together or joined together. That is called as consolidation in simple terms. Shall we move ahead? We'll go for the second example. We'll go for the second example now. Right. Now, what is the second example? On 1st April 2018, we have 10,000 equity shares of rupees 10 each. So this is the opening balance of equity shares. So as on 1st April, we have opening balance 10,000 equity shares of 10 rupees. On 1st April 2018, we also have 15,000 shares, but these are of 5 rupees each. Now this 10 rupees and 5 rupees is nothing but their face values. So you are having shares of 10 rupees face value. I'll write it over here, face value. And you also have shares of 5 rupees face value. You have to calculate weights. Now, can I say a share with a lesser face value cannot have the same right in the profit as the share with a higher face value will have? Yes or no? And I cannot have two different figures for these two types of shares. Can I have two different EPS? Means one EPS I'm calculating for 10 rupees face value and one EPS I'm calculating for 5 rupees face value. So that is not possible. You cannot have two different EPS figures. So EPS figure will be one, right? So now what we have to do is, on the basis of the rights in the profits, we have to work out the weighted average number of shares. So a simple point to be noted, different classes of equity shares. So convert the least face value share as if they are of the highest face value. Means if there are 15,000 shares of rupees 5, convert them to as if they are of 10 rupees each. So can I say 15,000 shares of 5 rupees each will be equal to 7,500 shares of rupees 10 each? Yes or no? And technically, this 5 rupees each share should have only half the rights in the profits as compared to the face value 10 rupees. So what you have to do is, sir, since we cannot have different figures of EPS, convert this 5 rupee face value share as if it is 10 rupee face value. So they will be considered as 7,500 shares for the purpose of EPS. So technically, they will be given earnings for only 7,500 shares. So how will we calculate this? Now please focus. Solution, calculation of gains, first. Now sir, these 10,000 shares are of 10 rupees face value, so no problem with that, no conversion to be done. So they are outstanding for a period of full 12 months, so 12 by 12. So they will be considered as full 10,000 shares. But sir, when I talk about these 15,000 shares, can I say they are of 5 rupees? But now we have to convert them as if they are of 10 rupees. So how to convert? Sir, simple, into 5 by 10. Means 15,000 into 5, the total value of the share is 75,000 rupees. So if this 75,000 is as per 10 rupee face value, so how many shares will come? 75,000 divided by 10, 7,500 shares. Multiplied by 12 upon 12. So they will be considered as 7,500 shares for the purpose of EPS. So 17,500 will be the wheels. Right? Assume if net profit given in the question was 2 lakhs. So therefore my basic EPS will be how much? Basic EPS will be 2 lakhs divided by 17,500. So 2 lakh divided by 17,500, 11.43. The basic EPS will be 11.43. Right? So technically, the face value 10 rupees shares, they will take 11.43 for 10,000 shares. And the 5 rupees face value, they will get 11.43 only, but not for 15,000 shares, but for 7,500 500 shares. That is, they will have half rights in the profits. So if the EPS is 11.43, right, they will get it only for 7,500 shares, not for 15,000 shares. Right? So please copy down this. And just wait for a minute. I will also paste the third question. So if anybody has completed with the second example, they can copy down the third question also. I'll just copy paste the third question. Yes.
Hello. Hello, sir.
Yes.
So can we convert the higher value to the for rupees 5 each?
So if you do that, now what will happen? The figure of EPS will be too low. So we don't do that.
Okay, so not even in any.
No. So what will happen if you do that? What will happen? This 10,000 will become 20,000.
Yes, sir.
And they are
Yes, sir.
15,000. So total will be 35,000 shares.
Yes, sir.
So your EPS will be exactly half of 11.43. So your amount will be very much low. 11.43 divided by 2. Your EPS will be only 5.71. Your EPS only will be 5.71. So why to show 5.71? Better you show 11.43.
Yes, sir. Yes, sir. Got it.
Right? Why to show 5.17 as a lower EPS? Show 11.43.
Yeah.
So don't convert higher to lower. Always convert lower to higher.
Higher. Okay.
So that you will get a fair value of your EPS.
$50,000 fully paid up shares.
Sir, why should a company can a company have two face values, sir? Like two or more?
They can have different classes. If they are having, because they are having, that is why we have this concept.
Right, sir. But I'm asking that can a company can have more than two or share or
Yes,
face values?
It can have. It can have. It can
Sir,
have.
and why we shouldn't go for the lower EPS, sir? Why for only for example, you said earlier that why should we?
Sir, you are an investor.
Choose?
1 minute. You are an investor, right? You are an investor. You will like to invest in a company with a higher EPS or a lower EPS?
But higher EPS only, sir. But for that, why should we choose this higher EPS so that we can get higher EPS, sir? Sir, for example, you have taken that okay, 20. You said that it can be converted into 20,000, no, sir, and that the EPS will be low.
I never said that.
Why shouldn't we convert everything?
Why? See, one person is asking one query, and you people are like drilling into it. It is very simple. Please convert lowest face value to highest face value. That's it. Don't convert highest to lowest. That will reduce the EPS figure. Don't reduce your EPS figure. Why you want to reduce your EPS figure? Show higher EPS. It is always better for the company. Why you want to show a lower EPS? If you want to show, you show it. That will be wrong. Because AS20 does not permit it. You want to show, you want to satisfy yourself, please show. I don't have a problem. AS20 does not allow.
Okay.
This is what AS20 allows, and it is correct. Because when you do this, you will have a better EPS. But if you do the reverse one, as I showed in the example, your EPS will be lower. And sir, trust me, no investor is willing to invest in a company with a lower EPS.
Okay.
So always show the higher EPS. And see, end of the day, your total net profit is going to remain the same, 2 lakhs only. Whether you show EPS at 11.43 or you show the EPS at 5.17. The total net profit is going to remain the same. So why to show 5.17? Better you show 11.43.
Okay, sir. Thanks.
people copied question number 3 or at least completed question number 2. Right? I can start with question number 3 now. Please understand the third example now. Sujit, wait now. Example number 3. 1st April 2017, we have 50,000 equity shares outstanding. The face value is 10 rupees and they are also fully paid up. On 1st July 2017, we have 80,000 shares issued of rupees 10. That is, the face value is 10 rupees, but only 6 rupees is paid up. Only 6 rupees is paid up. And on 1st December 2017, final call of the 4 rupees is made per share and it is received on full 80,000 shares. Means over here, sir, for the part of the year, some of your shares are remaining partly paid up. And then for the balance part of the year, they are becoming fully paid up. So in such cases, how to calculate the whales? Means, sir, if you see about these 80,000 shares, July, August, September, October, November, for a period of 5 months, they are partly paid up. And in 1st December, when the final call is made and it is paid by all the shareholders, so technically from December, January, February and March, 4 months, they become fully paid up. Yes or no? So my simple question to you, should they have the same right in the profits when they were partly paid up? Should they have the same right in the profit when they were partly paid up, or they should have lesser rights? Obviously lesser rights, because they are partly paid up, sir. So how to calculate the whales? Sir, in simple terms, you will use the same concept as you did for the different class, that is different face value. What concept you did? Convert the 5 rupee face value as if they are 10 rupees. Here also same logic. Convert these 80,000 shares on which you have collected 6 rupees as if they are fully paid up, that is as per 10 rupees. So please have a look at the solution. Please check how you are going to do this. Please check calculation of whales. Now, sir, the opening balance, that is 50,000 opening shares, for them, they are outstanding for a period of full 12 months. So they will be considered as full 50,000 shares for the purpose of whales. That is for the purpose of EPS calculation. But sir, please focus over here. When I talk about these 80,000 shares, can I say they are partly paid up? So convert this partly paid up as if they are fully paid up. So how to convert them? Sir, 80,000 into 6 rupees, 4,80,000 is what we received. Correct? 4,80,000 is what we received. Assume if this 4,80,000 is received for fully paid up shares, then just you have to divide it by 10. So this means 48,000 equity shares will come. Right? So technically they are 80,000 shares, but for the sake of rights in profits, they will be considered as how many shares? 48,000 shares and outstanding only for a period of 5 months. So they come to 20,000 shares. So for the sake of calculation of EPS, they will be considered as only 20,000 shares. Right? I'll just do one thing. I'll write a note over here. Convert the partly paid up shares to fully paid up for whales. Right? Now see, again people are doing mistake. Now somebody is telling me, sir, it is 9 months. Boss, from 1st December, they are becoming fully paid up. So if they are becoming fully paid up, how can you take them as outstanding for 9 months? Please apply common sense. July, August, September, October, November. Only for a period of 5 months they are partly paid up. From December they are becoming fully paid up. So now I will add up. From December they are now full 80,000 shares. No requirement of any conversions because now they have become fully paid up, and 80,000 shares will be outstanding for a period of 12 months. 4 upon 12 months. So how many number of shares come over here? That is 80,000 divided by 3. 26,667. So it is 96,667 is your gains. This is a common mistake that student does. Student considers this from 1st July to 31st March. Plus, please apply your common sense. These are partly paid up from 1st July, but to only up to 30th of November. Because from 1st December, they become fully paid up. So from 1st December, you will consider them as fully paid up shares. See over here, I consider them as full 80,000 shares outstanding for a period of last 4 months. That is December, January, February, and March. This is the area where majority of the students make a mistake. Or some people, they take it here 9 by 12 also, and again they do this 80,000 into 4 by 12. That is absolutely wrong. Please apply your common sense. These are partly paid up. These shares are in the partly paid up form only for a period of 5 months. That is July, August, September, October, November. That's it. From December, these become fully paid up. So you will be considering these partly paid up shares are outstanding only for a period of 5 months. Just wait for a minute. I'll just paste the 4th question and then you can copy down the rest. Now, 4th is the extreme. Extreme as in this is the most difficult one. Now, this can be maximum asked in exam. Have you completed the copying of question of example 3 so that I can scroll up? Okay. See, if you have copied the solution also of question number 3, then I can start with 4. In the next 2-3 minutes, I will be starting with example number 4. You completed the question solution of question number 3. Okay, now everybody please focus on the 4th example. This is the toughest and this is the maximum that can be asked in the exam for 5 marks. Now please understand. On 1st April 2016, we have 80,000 shares of rupees 10 each which are fully paid up. So these are outstanding for the full 12 months. Opening balance of shares I can say. On 1st April 2016, we also have 1 lakh equity shares, but these are of only 5 rupees face value and they are of fully paid up. And can I say they are also outstanding for full 12 months? Sir, when you have a smaller face value share, what you have to do is convert it to the highest face value. So 1 lakh shares of 5 rupees is equivalent to 50,000 shares of 10 rupees. Right? Then On 1st October 2016, 50,000 shares are issued of rupees 10 each, and 7 rupees is paid up. The paid up value is 7 rupees. Matlab, sir, we have partly paid up shares also here. Correct? So partly paid up also has to be converted as if they are fully paid up for the sake of whales. On 1st December, bonus shares are issued of 5 rupees face value. Means bonus will be only with respect to these 1 lakh shares because they are of 5 rupees face value. Right? So bonus is issued of 5 rupees face value in the ratio 1:2. Means 1 share for every 2 shares held. Now, can I say we have 1 lakh shares of 5 rupees? So how much will be bonus? Sir, 1 lakh into 1/2. So technically 50,000 bonus shares will be issued. Right? And they will be considered as outstanding for the full year. Right? But please understand, bonus shares are of 5 rupees face value. So you have to convert them to 10 rupees face value. So this is where student makes a mistake. Student writes 50,000 as bonus shares, but forgets to convert into 10 rupee face value. So technically only 25,000 shares will come. Then this is where majority of the students make a mistake. Final, on 1st January 2017, final call of rupees 3 per share. Final call of rupees 3 per share was made, of which paid up only by 40,000 shares. Now, can I say there were total 50,000 shares which were partly paid up? So you did a final call on 1st July. So when you did 1st January, I'm really sorry. So when you did the final call on 1st January, only 40,000 shareholders paid. So technically, from 1st January onwards, 40,000 shares become fully paid up. Right? And the balance 10,000 shares will still remain partly paid up. Right? So on this basis, we have to work out our veins now. So be very careful with the solution now. I want everybody to please focus. Don't write anything. This is one of the toughest one. And it is toughest because of the 4th point only. Now, sir, first, those 80,000 shares are outstanding for a period of full 12 months and they are of 10 rupees face value only. So no need to convert or do anything with them. So 80,000 into 12 by 12, we will consider them as 80,000 shares. Plus, sir, 1 lakh shares are of 5 rupees face value. So I have to convert them as if they are of 10 rupees face value. So to convert them, I will just multiply it by 5/10. Right? And they are also outstanding for the full 12 months because they are available from 1st April. So 1st April to 31st March, 12 months. So I will consider them as 50,000 shares. Correct? No issue still here. Now, on 1st August 2016, 50,000 shares are issued of 10 rupees face value, but sir, they are partly paid up. So partly paid up also has to be converted as if they are fully paid up. But sir, please understand, the time period will not be considered from 1st August to 31st March. No. They will be considered from 1st August to 31st December. Because from 1st January, some of them are becoming fully paid up and some of them are remaining partly paid up. So we will not consider them till March, we will consider only till December. That is August, September, October, November, December, 5 months only. So I will say 50,000 shares are partly paid up. So to convert them fully paid up, what I have to do? Multiply it by 7 paid up, divided by full paid up value is 10. Multiplied by 5/12. 5/12. I'm putting a star also. 5/12 means from August to December. From August to December. So what is the value? 50,000 into 7 divided by 10 into 5 divided by 12. It is 14,500 583. 14,583. Right? Now comes the bonus part. Sir, on 1 lakh shares, the bonus is in the ratio of 1/2. So can I say 50,000 bonus shares? But these are of 5 rupees face value, so convert them to 10 rupees face value. So multiplied by 5/10. And sir, bonus is always outstanding for the full year. So I've done 12/12. Final answer is 25,000 shares. Correct? So this is the crux. This is the crux. This is where the student makes a mistake. Student forgets to multiply by 5/10. Student calculates this properly as 50,000 shares. 12/12 is also correct. But sir, you have to understand bonus shares are of 5 rupees face value. So 5 rupee face value share has to be converted to 10 rupee face value. Right? So 50,000 shares of 5 rupees is equal to 25,000 shares of 10 rupees. Because we should have a same class of shares for EPS. We should not have different classes. Then, finally, sir, from 1st January, can I say 40,000 shares now have become fully paid up? Right? And they have become fully paid up from January, February, and March, 3 months. So I will directly consider them as 40,000 shares for a period of 3/12. Because now they are fully paid up, so no need to multiply by 7/10 or 3/10, anything like that. So directly 40,000 fully paid up, so they will be 10,000 shares. Right? And finally, sir, out of 50,000, only 40,000 have become fully paid up. Now, can I say 10,000 are still partly paid up? So for these 10,000, we have to multiply by 7/10 because they are still partly paid up at 7 rupees only. Multiply for a period of last 3 months, that is January, February, and March. So this comes to 10,000 divided by 10 into 7 into 3/12. 1750 shares. So the final answer comes to 1,81,333 shares. This is your wins. Now, one student can do, one small change student can do if they want with the third step. So here what they can do is, here only they can give a split. Means here they can consider 40,000 shares for 5 months. They can consider here 40,000 shares for 5 months and then show this 40,000 shares for 3 months. Right? And for this 10,000 shares, they can show directly 10,000 shares are outstanding, or I would say they are partly paid up from 1st August to 31st March. So they can show it in one point also. Means directly 10,000 into 7/10 into 8/12. That is from August to March. So that is one change, you can do it by yourself. So we have added the sir 10,000 shares which are partly paid up in the last part we are showing na. From January, February, and March also they are partly paid up. So we have considered them for 3 months. That is 3/12. I think people have not copied the question also. No? It is included in 50,000, but you please see the time period. Na? What is the time period that we have considered over here? 5/12. Mathematics is weak. See, 5/12 we have considered over here. Bonus also we have clearly mentioned it is of face value 5 rupees. So what shares are of face value 5 rupees? 1 lakh shares are of face value 5 rupees. Na? So technically bonus will be issued on these 1 lakh shares only. Na? So on these 1 lakh shares in the ratio of 1:2 means 50,000 bonus shares will be issued. Yes, you can use any different method also, but answer should be the same. Have you copied the question? Please take a screenshot now. I think there will be no ample time now to copy. Please take a screenshot of question number 4 and then take the screenshot of the solution also. In one full page question and answer is not possible, sir. Then it will be very small. This is the question. Please take a screenshot now. I'm shifting the screen now. I'm shifting the screen. This is the solution. Take the screenshot. This is the first question. This is the first question. I'm showing all the questions now. If anybody has not copied, this is the first question. Take a screenshot. I'm changing the screen. Second question. Third. And fourth, I've already shown. Last time I'm showing the second question. Now, please don't ask me one after the other. I've shown all the 4 questions. You have to take the screenshots. Right? So we have to please show answer for it. What you people do, when I show you, you have to take the screenshot. Every now and then you keep on telling to scroll from here and there. When I show you the screen, you don't take the screenshot. And after that, you tell me scroll to that question, scroll to this question. Yes, Preeti.
So could you explain the bonus share part? Like I got the 5/10 because the face value is 5 and 12 months completely for 1 year. What about the 1/2? Because of the ratio, is it?
Obviously, 1:2 is the ratio. Na?
Oh, okay.
So 1 share for every 2 held.
Okay, sir.
Like you will get 1 bonus share for every 2 that you are holding.
Okay.
So if you are holding 1 lakh shares, so you will get into 1/2. That is 50,000 shares as bonus.
Yeah, okay. Thank you, sir.
Right. So we'll end up this session over here.